When businesses want to grow, it's always a great idea to worry about how you're going to fund that growth. In this example, we're going to talk about organic growth without the addition of any additional funding from either equity partners or from debt, where you borrow that money to fund your growth. And you'll see that with organic growth, although it's nice and solid and the managers or the owners of the business can actually do it without any major stretching of their mind or their ability to manage the process, the downside is that you are very limited to the amount of growth you can do unless you do use debt funding or possibly equity funding. So in this example here, we're going for cost of goods of say $500,000, and we're saying that labour and materials equal $500,000 per annum. Assuming a 100% markup, that gives us a revenue base for year one of $1 million in sales. Consequently, if you take 500,000 away from $1 million to pay our cost of goods, you'll end up with $500,000 gross profit to run the rest of the business. So under our expenses, we've got rent, insurance, accounting, receptionist, and all of the other costs you have with running the business. In this example here, we said $350,000. For drawings, we're going to take $100,000 out of the business for us to live off as owners. So you add these two together, that becomes $450,000 for a year. You take that $450,000 away from your $500,000 gross profit, and you're left with $50,000 as a net profit take. Now, as a business owner or shareholder, obviously you are interested in this red part. If you can see the red part there, that's the net profit. That's what's available to come out to the shareholders. In year two, we want to reinvest that money back into the business, because we've always heard you've got to reinvest it back into the business. So if we were to ask the question to ourselves, if we were to pay our receptionist another $50,000, is that going to add value to the shareholder return next year? The answer is no. If we were to pay our accountant another $50,000, well, he'd be happy or she'd be happy, but it wouldn't grow our value to the business. If we were paying another $50,000 to our insurer, they'd like us, but it doesn't add value to the business. The only place that $50,000 can go is actually into our cost of goods sold. So we want to buy more material, or we want to pay for more constructive labour that's going to be actually fee earning. So in this example here, we've taken $500,000, we've added our $50,000 profit, and we've now got a cost of goods of $550,000. So that naturally, assuming a straight 100% markup, is going to give us a turnover of $1.1 million in our second year. Take that away from our material, and we're left with a gross profit of $550,000. Now, in this example here, I'm assuming that nothing else is changing, and this is unrealistic because obviously expenses do go up. But we're just transferring across these 4 years $350,000 of continual expense at the same level. Drawings at the same expense. So if we take away $550,000 minus $450,000, we've got $100,000 here. So we've effectively doubled our investment coming back out of our own business, and we've grown our business revenue by 10%. We're going to do the same thing again. We're going to add that $100,000 profit back into our cost of goods. So $550,000 now goes to $650,000. So that we just added the $100,000 back onto $550,000 across to here. So we're now going to reinvest $650,000 there. $650,000 goes to $1.3 million. Minus $650,000 gives us $650,000 left to run the rest of the company. We're assuming the same numbers to run the expenses right across here. We're assuming also the same numbers for our drawings. And that gives us $450,000 down the bottom. $450,000 away from $650,000. Well, look at that. We've gone from $100,000 net profit to $200,000 net profit. Again, we want to grow our business, so we're on a growth model now. $200,000 added to this. $650,000 goes to $750,000 goes to $850,000. So we now have $850,000 of material cost, which is our labour and our materials. We have $850,000 here, so we're talking now $1.7 million of revenue. We take our expenses out of here again, our $100,000 out of here, for our drawings. That gives us still $450,000. 850 minus 450 gives us roughly, and the cameraman's going to tell me how much?
400,000.
$400,000. So we've effectively grown our business from 50 to 100, from 100 to 200, which is fantastic growth, from 200 to 400. But our revenues have only gone up in the first year by 10%, a little bit more in the second year, a little bit more in the third year. Over a 4-year time frame, this is fantastic if your focus is on growth. But what the downside is that there's no dividends. So you are only making your drawings out of this business. The exception to this is if you decide to follow a model of growth by acquisition or growth by pumping up your cost of materials. And this is where you use debt or equity to increase this level of cost of goods. So for that, you need to be having real estate. Typically, most banks will allow you to borrow money on real estate, but when you get to a point of aggressive growth, now in New South Wales and in a lot of Australian countries, especially in America now, $500,000 might be backed by residential security, but if your residential security has not grown, then you can't borrow or offer the bank any additional funding. So you're going to have to start looking at debtor funding or factoring, or machinery factoring, or plant and equipment factoring, or financing. So you need to find some finance brokers that can help you fund the growth of your business. Alternatively, you've got to sell equity, or you've got to consider a merger or an acquisition. I'm Jeff Miles, the Business Doctor, and if I can give you any help, please send me an email to jeffmiles@thebusinessdoctor.com.au.